All right, I want to welcome you to our podcast, Marty and Ted Talking Taxes. My name is Ted Perkins. I'm with my co-host and partner, Marty Pezzner, and we're from the law firm of Gibson&Perkins in Media, Pennsylvania. Our topic today is the new partnership audit rules, which become effective for tax returns filed after January 1st, 2018. These are new rules, but they've actually been around since the Bipartisan Budget Act of 2015, which put them in place, but did not make them effective until January 1st, 2018 tax returns. Although I should mention that there was an option if your return was due after November 2nd, 2015, you could opt into the new rules. Now, Marty, you have some experience. The old rule was under TEFRA. That goes back to 1982. And you were actually a field agent for the IRS and had to operate under those rules. Would you explain what the old rule was under TEFRA and how it worked with the service?
Sure. So I was a field agent, and the field agents were responsible for the audit of partnership tax returns. That was part
How
of
did that work now? You audited the partnership tax, and there was a lot of this stuff going on too, because back in the 80s, we were still dealing with the aftermath of the tax shelter era. Actually, I guess the IRS in that point was really going after tax shelters. That was really the point where it really began to focus on the tax shelter partnerships.
That's correct. They called it a program, meaning there was a program in which certain auditors were assigned to the audit of these tax shelter partners.
Yeah, we should mention to those that were not practicing or even born back in 1982 that we used to have some fun with this. I mean, that's kind of being flippant, but you could actually organize investments, and the form of the entity was normally a limited partnership where the tax benefits were based on a multiple of investment. And we used to say, well, you get a write-off of $5 for each dollar of investment or something like that. But that caused the IRS to really focus on partnership audits. I think that's probably what inspired the TEFRA rule in the first place. But what was the default rule that applied and just until recently applied from that point on? What was the approach of the service under TEFRA?
So the approach of the service was if there was a proposed adjustment to the partnership, and assuming it was accepted, at that point in time there was a requirement on the part of the individual partners to file amended tax returns.
Well, wait a minute now. So the partnership would be audited at the partnership level.
Correct.
And there would be an adjustment. And then what happened after that? That would be then reported by the individual partner, at least hypothetically.
It would be reported by the individual partner, correct? Because as we all know, there's no tax
on a partnership tax
return. So K-1s were issued when the return was initially filed. So any adjustments were then allocated to the individual partners.
And you get an adjusted K-1 that you had to report on an amended tax return.
Correct.
Now, how did you follow up with that? I mean, this must have been kind of a mess from the services point of view. I mean, how did they figure out whether these guys actually made the adjustment?
Yeah, it was difficult, and sometimes it was to the point where the tax preparer would actually submit the returns as part of the audit to the field agent, and then the field agent would have those tax returns filed.
So it was up to the field agent to kind of follow through and see if these partners actually made the adjustment.
Correct.
Okay. Now, just as a side note, we ought to mention that the audit was handled, and this is a familiar term to a lot of people that have been involved in partnerships, by the tax matters partner. The tax matters partner was usually designated in the partnership agreement. It had to be a partner or in an LLC context, a managing member. And they would deal with the IRS on a one-on-one basis.
That's correct, and they would receive the notices. They would have special rights to conduct a partnership audit. But you brought out a really good point. Under TEFRA, it was an actual partner who was designated as the tax matters partner.
Yeah, I just mentioned that at this point because, as we're going to discuss later on, that term has been changed to partnership representative and who that is, and they don't have to be a partner anymore, and we'll talk about that later on. But under TEFRA, the exam was limited to partnership items, and partnership items were really items reported on the tax return that could affect tax liability in some way. That term has been kind of expanded in terms of its definition. We're now talking about partnership-related items, but we'll talk about that in just a second. So that was the TEFRA rule, which was basically the IRS would audit the partnership, make adjustments, issue K-1s to the individual partners. They would be responsible to amend their tax returns. And from the IRS's point of view, it sounds like that was administratively burdensome. So to a large degree, I think the new changes, the changes in the partnership audit procedure that we're now dealing with are focused on trying to make that a more streamlined process as far as the service is concerned.
That's correct. Part of the, or most likely the motivation for this change in the law was to help the IRS, just from a procedural side, to deal with these partnership adjustments.
All right, now for partnership tax years beginning after January 1st, 2018, you're now dealing with these new rules as far as how the audit is going to be conducted and how the adjustments are going to be made. What is the change? What's the default rule under the new procedures?
Well, generally,
just essentially, because there are some nuances to this.
Right, there's nuances. So the major change is that, assuming there's not an election out of this procedure, the tax is paid and assessed at the partnership level.
All right, let's just stop right there. The audit is conducted at the partnership level. That's not a change. But now they make an adjustment to the partnership tax return. Now, as we all know, a partnership tax return, there's no tax due.
Correct.
There are items that are passed through on a K-1 to the partners, but essentially those items are based on the taxable income of that partnership entity. And so if there's adjustments made to that income statement, if you will, tax-based income statement, that adjustment would result in a tax liability that is paid then by the partnership. Is that right?
It's paid by the partnership. That's correct. The taxation is at the partnership.
All right, now what's the tax rate then?
So the tax rate is the higher of the marginal rate for the highest rate for a corporation or an individual, the highest rate for an individual. So it's whatever the highest is between the two.
All right, now they use the term reviewed tax year. So when we're talking about the highest rate, we're talking about the highest rate in the reviewed tax year that would apply either corporate or individual. Now that, of course, in 2019, we have a 21% corporate rate federally, and 37% is the top marginal individual rate. So it would be 37%
that's
applied
correct
to the adjustment.
That's correct.
Now going back, it might have been 35 for corporations, 39.6 for individuals. But so it doesn't matter what the individual partner rates were, or it all is done at the partner level. You apply the highest individual or corporate tax rate effective for that year and determine a tax liability. And that, under the default rule, that liability is paid by the partnership.
That's correct, and it's referred to as the IRS. It's referred to as an imputed adjustment by the IRS.
That's an interesting thing. Now let's just talk about that, because that does a couple things. Of course, it streamlines the process. You don't have to chase down the partners. It makes it easier for the IRS. But it also imposes the economic impact of the adjustment on the partnership rather than the partners. Now, my question is, you got a 3-year statute. That partnership census, whoever those partners are, could have changed during that time period.
Absolutely.
So even though A, B, and C could have been partners during the reviewed year, and now they're replaced by X, Y, and Z, that doesn't seem fair to me, because then the partnership picks up the liability that should have fallen on those individuals.
Correct, and we'll discuss that a little bit further, but there's other options and there's other ways to equalize that situation. And just to clarify, so the reviewed year is the year, for example, the fiscal year of the actual partnership.
Well, it could be a calendar year too.
Or it could be a calendar year or a fiscal year. So the review year, for example, if you have a partnership that's a June 1st, 2018, and it ends May 31st, 2019, that's the review year. But as you said, there's a 3-year statute, so the actual audit may not take place let's say until 2021. So that's the adjustment year. And the partners in the actual adjustment year could be the XYZ, but the partners in the review year were ABC.
All right, well, we're going to talk about some of the ways you could possibly address that issue as the partnership or those partners. One thing we do want to mention, though, and I kind of mentioned this in passing, that there seems to be an expansion of the type of item you can look at and adjust. The old TEFRA rule was you were restricted as far as the service was concerned to what were referred to as partnership items. The new terminology is partnership-related item, and that's defined as any item or amount with respect to the partnership that is relevant in determining the tax liability of any person without regard to whether the item or amount appears on the partnership tax return. The old rule, as it related to partnership items, really restricted, at least in its terminology, to items that would affect the partnership tax return. This is a more broad-based definition. I would say, Marty, that in practice, maybe the courts showed some leniency and maybe expanded that definition beyond what it was originally intended to be. But just to give you some feel for this, how this is defined, here's some examples of what a partnership-related item is. Something that affects the character, timing, source, or amount of partnership income, gain, loss, or deduction, the basis, character, value, or type of partnership assets, the amount, character of partnership liabilities, including whether they're recourse or non-recourse, any item or amount that relates to a 754 election, and items or amounts resulting from partnership termination as well. Now, just going back to this, as far as the default rule and maybe some ways that you could have different options that are available, just to restate it, the big change, of course, is now that there's going to be an adjustment that is determined at the partnership level, and the liability for the adjustment based on the highest individual or corporate tax rate effective for that reviewed year would be paid by the partnership.
And I want to add something, Ted. Not only does it apply to the tax at the partnership level, but it also applies to any penalties.
Interest and penalty as well, right?
At the partnership level.
Now, one thing you can do is you can opt out. You can opt out if your partnership has 100 or fewer eligible partners, and you do that by, and when we say opt out, what we mean is you're opting out under these rules, and really now opting into what was the old TEFRA rule in a sense, because if you opt out, the adjustments would be made at the partnership level, but each individual partner would receive an amended K1 and would have to report that change on an amended 1040. Now, to opt out, how do you do this?
It's on the actual tax return itself. There's
The
a line
1065.
on the 1065 starting in 2018. There's an actual line item allowing the partnership to elect out of what they call the centralized partnership audit regime. And you check the box whether or not you want to, if you want to elect out, you elect out of it.
Okay, so that's done on a yearly basis. You can elect out, elect in, whatever you think is the appropriate election. I don't know how you predict that in advance, but whether that's a good option or not. And fortunately, I guess, there are some other options that are available as well. But the new 1065 will have a box you can check, and you can opt out on that. You can only do this if you have 100 or fewer partners.
Correct.
Otherwise, you're under the new regime. Now, there is also two interesting terms that crop up here. There's something called a pull-in procedure, and there is a pull-out procedure, or excuse me, push-out procedure that is also available. Now, under each of these, we were talking about this before, our podcast this morning, how they're a little bit different, but the effect is essentially the same of the two, which is basically the adjustment that is made is not, and the effect is not reported by the partnership now, but is pushed out or pulled in by the partner. So the adjustment is now on the partner, not the partnership. But it doesn't require an amended tax return.
Correct. There's a fine distinction. With the pull-in procedure, that's a procedure or an election that is done by the individual partners. But when you have the push-out election, that's done by the partnership itself.
All right, let's talk about the pull-in procedure for a second. Now, you're saying that's an individual election of the partner to do what?
The partner could, and it's the review year partner.
That's an essential point. I'm glad you brought that up, because we had talked earlier about, you have an audit that takes place a couple of years down the road. The identity of the partners that might have changed, and the economic burdens now in the current partnership and partners. So, the pull-in is that the partners in the reviewed year, the year under audit,
correct, not
not the current partners, elect to pick up the adjustments based on their pro rata percentage interest in the partnership, I would guess.
That's correct. And the IRS, they're going to provide a form and manner, but it allows the reviewed year partners to use this pull-in procedure, and it's a much simpler procedure than the individual partner having to amend.
So they don't amend their tax return.
They
They
do
just
not.
pay the liability. It doesn't affect the statute of limitation on that year either, as I
Correct.
understand it.
That's correct.
Now, the tax is based then on the impact on their individual tax return, not on this highest corporate or individual tax rate business.
Right. And it may be beneficial if the reviewed year partners have a lower marginal tax rate than the highest marginal income tax rate applicable to individuals or corporations, then it may be beneficial for them to use this procedure.
It's interesting, Marty, because if I was a partner who had left the partnership, I don't know why I would volunteer to be pulled in, if in effect. It raises a couple points. One is that it doesn't have to be all the partners that elect to pull in. Just to the extent that they do, it would reduce the liability at the partnership level. So if only a few of the partners elect to pay the tax liability individually, it then adjusts the amount that's due at the partnership level. But just to emphasize the point, it doesn't have to be everybody.
Correct. Not all reviewed year partners have to participate in this program.
This raises another point we're going to talk about at the end of the podcast, the way that partnership agreements might be worded. But you might want to include a provision that if you lead the partnership, that you will at least be eligible to be pulled in. You'll agree to be pulled in if that's the option, so that you don't have to go chase that guy down and twist his arm. I don't know how you'd even get him to agree to it. Now, so pull-in is basically done at the partnership level, at the partner level.
Individual partners.
Individual partner. They agree to pick up the liability. They do it based on the impact in their personal tax return as far as how much tax they pay. It doesn't affect the statute of limitations, and it doesn't have to be everybody. Now, how about the push out? The push out seems to be, now the push out, by the way, well, describe that, but this is available even during the audit of the partnership. In other words, you make this election during the audit.
Well,
or after the audit,
after
adjustments.
The audit.
After the audit.
After the audit, but again, the distinction is it's the partnership itself, and we're going to talk about this further. Where instead of a tax matters partner, you have a personal representative. That election is made on behalf of the partnership, whether you should elect this push out election.
I don't want to gloss over that point, just because we're going to come back to it, but the partnership now is electing to push out the liability, in effect, forcing the individual partners to pick up the liability on their individual tax returns. Again, the adjustment is made based on their tax rates, but that choice is really going to be made by this so-called personal or partnership representative who replaces the tax matters partner. But so that gives them a lot of authority there. And remember, now this is interesting too, because this gives you a mechanism where you can force the partners that have left to pick up the liability, even though they don't do it voluntarily under the pull-in. But so the determination is now made, in effect, to opt out of the rules, except that under this option, there's no amended tax return. It's just you pick up the... In other words, what I was saying was, if you opt out of the new procedure, you're now under the TEFRA rule, and the adjustments will be made, amended tax returns. This is a little different in the sense that you don't have to amend the tax return, but you do have to pick up the liability at the partner level.
Right. The partnership itself elects to have the entire assessment against the partnership at that partnership level eliminated. And it's eliminated by electing to have the reviewed year partners assessed instead of...
Again, a good point, because it's not the partners who are there now, but those that were in place during the reviewed year.
Correct. And you would ask the question, Ted. It's the push-out election. It has to be made by the partnership. It's 45 days. They call it an FPA, or a final partnership adjustments issue.
So that would be at the end of the audit. You can do this at that point. And it would require, I would think, even in the most cooperative circumstance, that you do kind of a comparative effect of what's the best way to do this. Pay it at the partnership level, maybe a pull-in or for some, and not for others, or maybe a total push-out.
Correct. And you know, procedurally, the partnership, they'll issue statements for each year to each partner, and the IRS gets a statement of which reflects the allocation.
Now, just to kind of review where we're at with this, and summarize a little bit of this. The new procedures apply for January tax returns after January 1st, 2018. You could have applied them if you'd opt in for any tax return that was due after November 2nd, 2015.
That's correct.
The new rule, the default rule, is that the adjustments are made at the partnership level. The tax is paid at the partnership level. You can opt out of the new procedure if you have 100 or fewer. You got to do that on the tax return, the 1065, by checking a box. If you're under audit and you now have a couple options. One is the pull-in procedure, where partners agree to accept the additional adjustment and pay the tax at the partner level, or the push-out option, which really makes the choice at the partner level to do the same thing, force the partners to pick up the adjustment on their individual, not on their individual tax returns, because it's not an amended tax return, but they would effectively do the same thing.
Right. It's a centralized system. The whole point is so individual amended tax returns don't have to be filed. And I want to just make everyone aware that if you do decide to elect out, there's an actual separate schedule that's still in draft form as we speak today by the IRS. Hopefully it will be finalized, in which the partnership could elect out of what they call the centralized partnership audit regime.
Now, I just want to mention a couple other points before we wrap up, and that one is this concept of the tax matters partner as opposed to the partnership representative. The statute really gives the partnership representative more power than the tax matters partner enjoyed. The partnership representative is the only person that can act on behalf of the partnership during the audit. The other partners have no rights to participate in the examination, and the statute says neither the partnership agreement nor state law can restrict the power granted to the partnership representative. The eligibility rules for who a partnership representative could be are a little different than what we had for a tax matters partner. Tax matters partner actually had to be a partner, but a partnership representative does not have to be a partner, and the only restriction is that they must have a substantial presence in the United States. And could be anybody, could be an attorney, could be a CPA or some other individual that you want to appoint. But how do you go about appointing your partnership representative in the first place? The tax matters partner, we usually had a provision in the partnership agreement that X was the partnership tax matters partner, or they would be appointed by the general partner, something like that. What about this person?
Yeah, this designation of the partnership representative is actually done on the 1065 tax return itself. You designate the personal representative, which includes the personal representative's ID number, name, etc.
Partnership representative.
The partnership representative. Yes, the partnership representative. That designation of the partnership representative is done on the actual tax return at the time of the filing of the tax return. So that's something that has to be decided. And like you said, Ted, from a practical side, the way I'm looking at it, most likely it'll be the tax professional.
Well, you know what, Marty? It's not just a throwaway choice either. You know, I can see what's going to happen. A lot of people are going to get down. They're going to prepare these 1065s. They'll get down to that line and they'll just fill in, you know, the I don't know, the guy they deal with when they prepare the tax return. But this person has a lot of authority to make these adjustments. And also the push-out election, it could be somewhat controversial among the partners. So it is something that should be given some thought. It's done on the tax return. And by the way, we should note that if it's not done effectively, if you just leave that blank, the IRS will procedurally come back to you and ask you to appoint somebody. But ultimately, they have the ability to appoint somebody for you if you don't do it. I think that'd probably be an extreme situation.
Yeah, I agree. I mean, that's the default. And like you said, for those who are preparing 1065, it's an item you may want to address, you know, up front and give it some thought. Like you said, it could be someone involved in the partnership itself, or again, it could be the tax professional. Because the tax professional, in other words, they're going to handle the audit themselves, based upon, you know, what.
Yeah, but I'd be a little concerned about that from a couple different points of view. Number one, they also have the authority to make the adjustments. So you might want to include in your partnership, this kind of segue into our maybe final topic, that you might want to, in the partnership agreement, require that before they agree to adjustments or a push-out option or something that materially affects the liability of the individual partners, that they get the approval of the majority or the managing partner or somebody, some sort of governing stopgap authority over that exercise of discretion, I would think.
Yeah, I agree with you on that. This should definitely be addressed in the partnership.
Well, here's the other thing too, Marty. If I was that guy, I was appointed and I wasn't a partner, I want some indemnity provisions to make sure that I didn't get sued by the partners because they didn't like the decisions that I had made. I think that raises the point, as we kind of led into this, that the partnership agreement should address not only the manner in which the partnership representative is appointed, but also can be unappointed, and maybe how we govern the authority that we're granting to those partnership representatives. Another consideration, of course, when you file the 1065 is whether you want to opt out or opt in to the new regime. Given the fact that you can have a pull-in or push-out option if you're audited, maybe that would be a premature type of election that should wait until you see what the lay of the land is pursuant to audit.
Correct, and if you have larger partnerships, but they're 100 or fewer, you may want to give it some thought before you make that election to opt out.
Okay, well, that kind of brings us to the end of our podcast. We thank you for tuning in today, and we hope this has been helpful to you, and we look for you for the next time around. Thank you, Marty.
Thank you, Ted.
All right, have a good rest of the day, and signing off from Marty and Ted Talking Taxes.